And hello, everybody. Well, just a couple of notes before I begin. I just need to say that this webinar is providing information only today. We're not providing advice, just really aiming to give you the tools and the knowledge to make your own decisions about your company benefits. And we are not connected to any other organisation, and we don't have any products to sell. So the information that we're giving you today is independent and unbiased. So let's start then by asking the question, what are benefits and do they really matter? Now, in short, company benefits can be anything that an employer offers to you for working for them. And really, they're giving them to you with the aim of supporting your lifestyle and well-being, but also to make them more attractive as an employer so that they can attract, keep and support the employees that they want. So benefits can include everything from providing coffee, tea and fruit in the office, all the way through to things like pension contributions and will writing services. And the answer as to whether they matter is yes, but only if they're relevant and useful to you. Now, not all benefits are going to be relevant to everybody because normally companies offer a wide range of benefits to suit a wide range of employees. For example, maternity and paternity pay is unlikely to be relevant if you're not planning on being a parent. Or it might be that you get offered private medical policy through work, but you've already got that through a partner's work as well. But even if there are some benefits that aren't relevant to you, they absolutely shouldn't be ignored because they can be incredibly valuable if they're used correctly. And that's where this picture of the horse comes in. It's supposed to represent don't look a gift horse in the mouth, take full advantage of what's being offered and use those benefits to their full potential, particularly because through work, benefits are often offered as free, and otherwise you'd need to go outside of work and pay for them yourselves. So really the key messages to take away today is one, understand what's available to you. Know whether that benefit is free to you or whether it's available at a reduced cost or whether it's going to save you from paying some tax. Then think about, is that benefit going to help my family as well as me? And if there is a benefit that you can choose rather than just being given automatically, what time of year can you choose that? When can you make a change? And often companies will have benefit election periods. They're normally between about 2 and 4 weeks in the year, and you might get a login to a benefit system in order to make your choices. And the other thing we're going to just touch on right at the end is really thinking importantly about the value of your full package, including those benefits, particularly when you're looking at comparing job roles. Now, some jobs might have lower salaries, but once you've added in sick pay benefits, pension contributions, death benefits for your family, that value of your package as a whole can be a lot higher than if you went to an alternative employer who though they might be offering just a slightly higher salary, they may have fewer benefits. So we're really going to look at that as we go through. But to kick off, we're going to look at some of the more common benefits that are offered by employers as we go through. So we're going to be looking at pension, income protection, death in service, critical illness, private medical insurance, and medical cash plans and dental plans as well. And we'll touch on a few of the ancillary benefits as well. But not all benefits are going to be offered by all employers. So it's really important to check your contract of employment to see which ones you're entitled to. But before we go through each of these ones on screen, it's just going to be helpful to have a bit of background on the tax treatment of benefits. So let's look at that now. Now, firstly, some of you may be offered benefits like pension, critical illness, which operate on something that's called a salary sacrifice or salary exchange basis. Now, under the rules of this scheme, what you do is you agree with your employer to give up some of your salary in exchange for a benefit. And because your employer is giving you a benefit rather than cash, it means that you then don't pay tax or national insurance as if you had have done if it had been income. So let's dig a little deeper into this. So let's say you're a basic rate taxpayer, which means roughly you're earning under £50,000. If you receive salary above the personal allowance of £12,570, so that's that first amount you're allowed to earn tax-free, any salary you receive above that, you're taxed at 20% and you also pay national insurance of 12% of your salary. So actually, any earnings that you get above that 12,570, you only get 68% of it because the rest is being taken out by the taxman. But if under a salary exchange scheme, you change some of that salary, you exchange it for a benefit like pension contributions, your employer takes that contribution from your gross pay and they use that money to pay over into your pension as an employer contribution. And because that money isn't actually then paid to you, because you've exchanged it before it's paid to you, it isn't classed as income. So you don't pay tax or NI, and 100% of that money goes into your pension rather than you losing the majority of it. And there are other benefits as well that can work under salary sacrifice and salary exchange. Some of the more common ones are critical illness, electric cars, bike to work schemes, things like that. The other advantage of salary exchange is that it does have the benefit of reducing your gross salary, which means you might be entitled to state benefits that you wouldn't have been if you hadn't have exchanged that salary for benefit. So a good example of this is child benefit, because if you earn more than £50,000 a year, your child benefit starts to be taxed. If you exchange some of your salary for a benefit, instead, that can bring your gross salary under that 50,000 and you'll continue to be entitled to the full amount of child benefit. So salary sacrifice and salary exchange not only has the advantage of reducing tax and NI, but it can mean that you continue to be entitled to some state benefits too. Now, there's also some benefits known as benefits in kind, which means that you might need to pay tax on them. And a benefit in kind is anything that's beneficial that you receive other than actual money. So typical benefits in kind are things like company cars, private medical insurance, which is paid for by the company, or loans at preferential rates. Now, there are two ways that you can pay tax on benefits. The first one is that either your employer will just work out what the tax is that's owed and they'll deduct that through payroll and pay it over to the taxman. And that's becoming the more popular method nowadays. But the alternative is you might get a form P11D at the end of every tax year. You get that from your employer and it shows you which benefits in kind you've received. That P11D is also submitted to the taxman on your behalf. And then for the following year, you might find that your tax code is altered so that you can earn less money before paying tax so that the taxman recoups it. Now, if your employer does use the P11D method, you will get a P11D by about the July after the tax year end. So that's broadly all you need to know about tax on benefits. And now let's look at the benefits themselves. So we're going to start by looking at pensions, and they're there to provide us with an income in later life when we choose to stop working. And pensions are usually the benefit that employers spend the most amount of money on for their employees. Now, in the UK, anyone who's employed, aged over 22 and earns more than £10,000 a year has to be automatically enrolled into their company pension scheme by law. Now, the reason for this is that the government are keen for people to save for their own retirement and not just rely on the state pension, because we're all living longer. So we've potentially got more years in our retirement. And one of the ways in which the government encourage us to save into pension is that they make it the most tax efficient way of saving. So we all get tax relief at our highest rate on any contributions we pay in. So if we earn £100, we get to keep that £100 rather than it being taxed NI. Once that money goes into the pension, it grows tax-free. And then when we decide to draw on that money in later life, we can have up to 25% of that money that we've saved in our pension as a tax-free cash sum. And there is no other savings vehicle that gives us that much tax relief. And another advantage of pensions is around inheritance tax, because the pension pot that you build up can be paid free of income and inheritance tax to a beneficiary of your choice if you were to die before you spend all of that money. And that's because your pension sits outside of your estate. So it'll be really important when you join a pension scheme with a new employer, they will ask you to complete a nomination form. Sometimes that's called an expression of wish form, and that's where you can state who you would want to receive that money. So please do make sure you filled that in and that you update it every time your circumstances change. So in terms of the company pension, firstly, find out how much is your employer paying in and how much are you contributing. Normally you'll be asked to pay in a percentage of your salary, but many employers have got pension schemes where they will pay more in if you do, they will match contributions up to a certain percentage. So it's always worth mentioning or seeing what you need to pay in order to get the maximum from your employer. Then take a look at where that money has been invested. If you don't make an investment choice, your company will decide for you, but often you get lots of choices of funds. So take a look at the booklet to see where you can invest your money if you want to. And nowadays, most pensions have online logins where you can see how much you've saved, where your money's invested, how much your employer is contributing, very much like online banking. So if you haven't already, find out the details and get yourself signed up so that you can keep track of your pension. So your action points then: log into your online pension account, check that you're making the most of any employer matching contributions, and keep that expression of wish form up to date. Now, the next benefit, which is one of the more common benefits offered by employers, is death in service. And this is a life insurance that pays a lump sum, again, to somebody of your choice in the event of your death. And that's if you die whilst employed. Now, most employers will provide a multiple of salary as a benefit, typically between 2 and 4 times your basic salary. But I have seen some company schemes as generous as 8 times salary for everybody. And this is a benefit that you don't have to pay tax on, and it's typically paid for by your employer. Now, in some cases, it might be that your employer gives you a core level of cover, let's say 2 times salary. But if you want to, you can elect a higher amount, particularly if you've got family who are dependent on you. And that's what you need to think about. What would happen if you weren't around? Who do you support financially now? Who might need that money? So you can make sure that you're filling out the beneficiary form so that it goes to the right people. Now, the beauty of getting this life cover through work is that normally you don't have to do any medicals and you don't have to fill any forms, and your medical history is normally disregarded. So it's a really easy and cost-effective way of getting life cover. But as I say, just like pension, you've got that nomination form to complete. So please do make sure you keep that up to date as your circumstances change. Sometimes as well, employers will offer partner death in service so that you can get life cover for your partner, even if they don't work for your employer. Normally, you can buy life cover of anywhere between about £10,000 a year and £250,000 a year. And again, medical conditions are often disregarded. So do look to see whether you can cover your partner as well, if that's applicable. Now, the next benefit that many employers offer is income protection. This is an insurance that's designed to provide you with a proportion of your income to support you if you were off work due to illness or injury. Now, often income protection will kick in after any discretionary sick pay that you receive comes to an end. But again, it can be different for all employers. So take a look at your contract of employment to see what you're likely to get. And most employers don't really give sick pay for more than about 6 months. So that's when this would kick in. So with income protection, you're normally covered for between about 50 and 75% of your basic salary. It may even cover your pension contributions as well. More common schemes pay that salary up to 5 years. More generous company schemes might pay all the way up to state pension age. Now, when it comes into payment, if you did claim on this type of insurance, any money you get would be taxed as earned income because you're not actually paying any tax on having that benefit provided for you. Now, one of the things that is worth checking is that if you do get income protection through work, see whether you've got income protection outside of work as well. Maybe you've got it with a bank account or insurance product. If you have got it outside of work and inside of work, you might be double covered. You might not be getting that payout from your independent one. And that is because most insurers don't allow you to insure more than about 60% of your salary because they want you to have an incentive to return to work in the event of a claim. So please do make sure if you've got a policy in work that you haven't got one outside of work as well, because you might be paying for that for zero benefit. Okay, on to critical illness now, and this is usually a benefit that if it is offered, it's normally optional and one that you would need to pay for yourself. Now, critical illness cover usually provides a tax-free one-off lump sum payment if you are diagnosed with one of the illnesses that are covered by the policy and you survive for at least 14 days. And even if you survive that illness, if you have treatment and then you carry on, you will still get a payout if you've got one of the illnesses covered under the policies. Typical kind of critical illnesses include strokes, heart attacks, cancer, and 80% of claims are for those three illnesses themselves. Now, the idea of this protection, of course, is that lump sum payment could help to pay for things like your mortgage, your debts, or maybe even alterations to your home if you need things like wheelchair access. But once that payment is made and that lump sum payment is in your account, that policy comes to an end. So you can't claim on a critical illness policy twice. Now, the cover for critical illness through work is normally in increments of £10,000, so £10,000 being the minimum payment, all the way up to about £250,000. And again, the real benefit of choosing this through work is that often pre-existing conditions are excluded, but it will depend on the policy that your employer has negotiated. Now, critical illness is one of those benefits that can be provided through salary exchange. So it means that you will save tax and NI on the cost of it as well. And what I will say here is, having just been through the process of getting critical illness outside of work, because it's not offered through my employer, it really can take some time if you do it independently. I've had medicals, they've written off reports from the GP. The whole process took about 3 months. So if you do need it, if you do get it through work, it is more likely to be cost effective and streamlined to do it that way. The next benefit, and this one's quite common, and that's private medical insurance. And that provides quick access to private healthcare facilities and treatments so that you don't have to wait in queues on the NHS. Now, sometimes employers will pay for the benefit just for you. More generous employers might pay for all of your family to be covered as well. But whatever you are covered for, this is a benefit in kind. So you will pay tax on the amount of money that is being paid to cover you. Now, most people get covered automatically without the need for a medical, but you might have an excess to pay. And again, that will depend on what your employer has negotiated. So say, for example, you had treatment, you would need to pay the excess, which is typically around the £100 mark, and then the private medical insurance will pick up the rest of the bill. Those excesses can be up to about £500. And the good news about private medical is sometimes with that, you'll also get access to a digital GP and online health information as well. Now, if you were going to buy this for yourself, private medical insurance could be anywhere between about £1,200 and £2,500 a year, depending on your age, your health, the area that you live in. So this really is a valuable benefit if you get it through work. The last benefits I'm going to touch on in detail today are dental plans and health cash plans. Now, dental is, as it says on the tin, this is an insurance that gives you different levels of cover for you and your family. So you get reimbursed, for example, if you go for checkups, if you go to the hygienist and things like that, it normally just pays the dental treatments directly. If you get it through work, it's normally offered at a group price, so it is cheaper than getting private dental outside of work. The other thing, which is health cash plans, these are similar in that you can claim back money for a wide range of medical treatments. So things like physiotherapy, osteopathy, and even NHS prescriptions you can claim back if you've got the cash plan. And with prescriptions at just under £10 a pop at the moment, that can really build up over the year. And also, typically, you'll get some money on the birth of a child, and you will get personal accident insurance thrown in as well. So do check whether you get access to this, because typically just for a few pounds each month, you can claim for a lot of money back. And the great thing about this benefit is that often children up to the age of 25 are automatically covered as well. And normally you'll have the option to cover a partner or a spouse. So in addition to all of those benefits that I've gone through in a bit of detail, you'll often find that your employers will have other range of benefits as well that you can take advantage of. Most employers will have an employee assistance program. This is a 24/7 confidential helpline that gives you practical advice and counselling support if you need it. And it isn't just money issues they can help you with. It can be family matters, bereavement, even neighbour disputes. So do take a look whether you've got access to that. Other sorts of schemes, you might have access to discounted bikes. So this is where you choose a bike at a discounted price, and then the money for it comes out over, let's say, a couple of years through salary. And again, these schemes are through the salary sacrifice scheme, so you can save tax and NI. Often, and this is becoming more and more popular, employers will allow you to buy and sell holiday days to make that holiday fit in with the life that you lead. It can be quite expensive to buy holidays. Normally it's 1/260th of your salary, because that's how many working days there are in a year. But if you need more because you want to go away more, or you've got kids to look after, that can be really valuable. And watch out for perks, things like will writing schemes, where you can pay a group rate and you can get a will done during work time. And sometimes you might be offered things like cheaper travel insurance as well. Now, a couple of benefits that really come into their own during the cost of living crisis is lower rate loans through payroll, and also discount schemes as well. So discount schemes where you can get money off your weekly shop or thousands of retailers around the country, really to help people to pay lower prices for the things that they have to buy day in, day out. And I am finding that employers are getting really inventive now, because it's not all about the cash. It's about finding things that are really going to support the lifestyle of their employees. An employer actually teamed up with earlier this week offers emergency childcare and reduced rate nurseries as well, so that they support new parents. So really what I'm saying is, please do find out what your employer offers and whether you're making the most of those benefits that are relevant to you and your family. Now, I alluded to this earlier, but I think it really is worth hammering home. Benefits can be incredibly important to take into account when you're changing job, because even though you might be offered a higher salary elsewhere, it could be that you're missing out on some really key benefits by changing to another employer. So a really good example of this could be parental leave pay. So again, a company I worked with last week, they offered both parents 6 months full pay when having a baby, which is incredibly generous, because by law, companies only have to offer 90% of salary to a mother for up to 6 weeks, and thereafter, up to 9 months, she'll receive statutory maternity pay, which is £172 and £48 a week. The supporting parent is only entitled by law to 2 weeks leave, and that's at that £172.48 a week. So as you can see, somebody that might leave a company for a higher salary in this situation, but then chose to have a baby, could be seriously losing out if the new employer only paid the statutory parental benefits. So that's why it's so important really to check the details before you move to a new employer. And of course, remember that benefits can be used as a negotiating tool as well. For example, if you get higher pension contributions at the job you are now, you're moving to a new role where the contributions would be lower, you could use that as a negotiating tool to try and get your salary up to compensate for that loss. So bringing it all together then, understand what's available to you, know whether it's a cost to you or whether your employer pays for it, and is it part of a salary exchange or a salary sacrifice scheme that could save you tax and national insurance. Then work out what benefits not only you need, but those that might support your family as well. Can you get the health cash plan? Can you cover your partner for private medical, as an example? And then know what point in the year you can choose and change benefits, and always consider the full package that you have rather than just salary alone when comparing roles. So that was just a quick rundown today before I go to questions. But before I do, please don't forget the fantastic services that are offered by the ICE BEN Fund and Support Network, who have sponsored this webinar today. They provide financial, workplace and wellbeing support to you and your families. And I have put the website and the helpline numbers here so that you can find out more if you want to. Right, Sarah, that's brought me to the end. Have we had any questions then?
That's great. Thank you very much. Lots of really great content there. So to start with our first question, I am opted into my employer's pension scheme. Is it worthwhile, or is it better to source an external pension supplier that I can take from job to job?
Yeah, that's interesting, because if we roll back about 20 years, it was quite common actually for people to have their own personal pensions and to ask their employer to pay into it. Nowadays, employers, or very, very rarely, will do that, because all employers have to automatically enrol you into a pension scheme. From an administration purpose, that is the one that they will pay into. And if you've got a scheme where your employer will pay contributions in, or even match contributions that you make, that is well worth doing. If you opted out and just had your own one, you're not going to benefit from the employer contributions or those matching schemes. So, if it's always worthwhile making the most of your employer scheme. You can, if you want to, at any point, transfer the money built up in that employer scheme to a personal scheme if you want to. But in order to get the employer contributions, really think about staying in the company pension scheme that you're offered.
That's great, thank you. Next question. At present, my company offers a good maternity leave package in excess of statutory limit, but only 2 weeks paternity leave. Am I allowed to request a more comprehensive paternity leave package so that I can support my wife and my new child better?
Yeah, I'm really glad that question's been asked. And do you know what? That's quite normal that, and I think it is changing, that maternity leave is often more generous, but paternity leave isn't. But there is this lesser known fact that there is something by law that you're allowed to take called parental leave. So if you have any children under the age of 18, you can apply to have up to 18 weeks off unpaid in the first 18 years of their life. Now, you have to apply for it in week blocks, so you can apply for 1 week parental leave, all the way up to a maximum of 4 weeks in any 1 year. And of course, you're not allowed to exceed that 18-week limit in the first 18 years of that child. Now, if you did want to consider applying for parental leave, you do need to give your employer 21 days notice in order to do that. But that is a way, if you've got the savings or the income to do it, that you may be able to have a little bit more time off work in order to do that. And of course, some employers will be flexible. It is worth just talking to them, explaining the situation to see whether they may have some other opportunities as well.